Good afternoon, ladies and gentlemen, and thank you for coming to one of one of the final presentations of Decentralized 2018. I hope you have enjoyed it thus far. Accounting is not known as being one of the most exciting of professions. However, it's a necessary evil. All companies have to file financial statements at the end of the year, and I've attended a number of presentations during this Decentralized, and a lot of the products are still in R&D, they're still in research and development, and they're coming out shortly. The need for accounting, though, for assets is not going to come shortly. It's here, and it's been here since the crypto assets have been developed. A bit about myself before getting into the presentation. I come from the accounting profession. I spent 8 years in the City of London before returning to Cyprus and spending the last 18 years in a number of industries. I've been in the media industry, I've been in the content production industry, I've been in the electronic banking industry, and as of lately, I'm running Grant Thornton's DLT, Distributed Ledger Technology Unit. During this period, I've been part of teams that have developed some quite revolutionary and disruptive products for their time. 2005, we developed Cyprus's first online portal, and that was at a time when advertisers were still fighting to get their clients' adverts on pages 3, 5, and the back page of magazines. I was then involved in the development of an OTT project. OTT is what Netflix is, having a global niche audience reach. Then set up one of Cyprus's first electronic money institutions that are daring to challenge the supremacy of banks. This is what Bitcoin and cryptocurrencies are doing. They're challenging the hold that the banks have on the global economy. Now, coming to cryptos, they have brought to the accounting profession a bit of excitement. And that's due to the fact that accountants don't know how to actually account for them. There's no guidelines that have been issued by the profession's governing body, the IASB, International Accounting Standard Board, as to how to account for these assets. This has led a number of national accounting boards to issue their own discussion documents, and more recently, Belarus has in fact issued its own official accounting standards for crypto assets. Are they assets? If they are assets, what kind of assets are they? I will attempt during the presentation to, by going through various categories of assets as classified by the International Financial Reporting Standards, to see what profile these crypto assets actually fill and how they should be presented on a company's balance sheet. So let's get right into it. First category we're looking at is that of cash and cash equivalents. As a form of digital money, one could think that crypto assets could be classified as cash under IAS 7. However, there's a big difference between cash and crypto assets, and that's the fact that crypto assets are not backed by any government, any central bank. They're not apart from other Venezuela, I don't think they're considered as a legal tender anywhere else, and they cannot be readily exchanged for any goods or services. So they're not cash. What about cash equivalents? Could they be cash equivalents? Cash equivalents are instruments that are of a cash-like nature, and as defined by IAS 7, they're short-term, highly liquid investments that are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. Now, given the recent volatility in the value of crypto assets, one would not be able to classify them under that category. And in order to preempt a question from Gregory during the questions and answers session, and I want that taken off my time, by the way, what about stable coins? Could you classify stable coins that actually have much reduced fluctuation in value? The short answer to that is, I don't know. There's nothing out there, still no guidelines, but if I was to actually make an estimate on that, make a judgment on that, I would say that as long as the backing of that asset is indeed stable, I could stand in front of any regulator and actually say, yes, let's classify stable coins as cash equivalents. Now, the next category I want us to have a look at is that of financial instruments under International Accounting Standard number 32. For a crypto asset to be classified as a financial instrument, it needs to satisfy some of the requirements of that standard. To be financial asset, there should be cash, there could be equity instruments, they could give the holder a contractual right to receive cash or another financial asset, or there could be contracts to be settled in equity instruments. Cryptos are none of that. They're not cash, they're not equity instruments, they do not give the holder any contractual right to receive cash, and they're not contracts to be settled in equity instruments. So they're not financial instruments. Next category is that of investment property under IAS 40. As defined by the standard, investment property is property, land or building or part of a building, held to earn rentals or for capital appreciation. Some companies do hold crypto assets onto their balance sheets in order to benefit from appreciation in value of that asset. However, that does not make it an investment property, merely due to the fact that it is not a tangible asset, and investment properties are tangible assets. The next one is a bit of a giveaway, property, plant and equipment. Of course, the fact that they are not physical property and no physical form does not make them property, plant or equipment. Next category is that of intangibles, IAS 38. The definition of an intangible is an identifiable, non-monetary asset without physical substance. How do cryptos fit? Let's break the definition down to its component parts. Identifiable. IAS 38 defines identifiable, an asset which is either separable, i.e. capable of being transacted on its own or as part of another identifiable asset or liability, or it arises from contractual or other legal rights. The second part is irrelevant because there's no contractual or other legal right to a crypto. However, given the fact that crypto assets are traded on exchanges or on a peer-to-peer basis, and an entity can expect to have an economic benefit from those transactions in the future, I would say that they are identifiable assets. Non-monetary. The definition of a monetary asset is money held and assets to be received in fixed or determinable amounts of money. When it comes to cryptos, the amount of money to be expected is neither fixed nor determinable, but it depends very much on the rules of supply and demand in relation to that particular asset. So I would not say that they are monetary, they are non-monetary for the definition of the standard. And of course, their digital nature makes them not having any physical substance. So I think we've got an answer. They are intangible. So how do we account for them now that we've determined that? There's two ways. There's the cost way and there's the revaluation. Cost is defined as the amount of cash or cash equivalents paid or the fair value of any other consideration given in order to acquire an asset at the time of its acquisition or constructions. On initial acquisition, intangible assets are measured at the cost, and then at the end of every year, they're written down depending on accumulated amortization and any impairment losses. Based on the revaluation approach, in order to implement that, there needs to be a market, a tradable market for the particular assets. And given the fact that cryptos do have exchanges on which they're traded, I would suggest that yes, the revaluation approach is the appropriate one to use when it comes to valuing of those assets. Just to speed up a bit. Do we amortize them or do we calculate impairment in value at the end of every year? IAS 38 requires that a company defines whether the useful economic life of their assets, of these intangible assets, is finite or indefinite. Given the fact that the company would expect, given the fact that crypto assets are are meant to be a store of value, the company would expect to have economic benefits from those assets over a long period of time. So that would actually suggest that the way to write them down is by finding at the end of every year, finding the actual value of those assets at that particular point. And that is done by measuring the current value compared to the recoverable amount as of that period. Now, as with everything else in life, there's always an exception to the rule. And this is no exception. There are cases where crypto assets could be classified as inventories and not as intangibles. This is a case where they are held by the entity for sale in the ordinary course of its business. If you go to a crypto fund, you cannot tell them that all the assets you hold are intangibles. Funds are in the business of trading. So I would suggest that our view on that is that all assets of crypto funds should be treated as inventories. I'm speeding up. That's a summary of what we've been discussing. Some other important issues to consider, forking. Forking is a bit like a spin-off that a company does in the financial reporting perspective. It's like a spin-off where the holding company spins off the shares of its subsidiary by distributing them to its existing shareholders in proportion to their holding, and which they treat as dividends. Forks, of course, are not dividends and should not be treated as dividends. What you get is the initial class of assets, which usually following the fork is worth less than it did before the fork, and a new class of asset which is identical form, so it's classified identically as the original class. ICOs, I mentioned earlier on the Belarus standards. Those standards suggest that a company that issues its own cryptocurrencies should not be allowed to acknowledge them and represent them and reflect them onto its financial statements. However, given the fact and the provisions of IAS 38, as long as the asset and the company expect to receive future economic benefits from those assets, they should be, and there's a trading market for those assets, they should be allowed to recognize them onto their balance sheet. Miners is the next one. This is a bit of a more complicated issue. Miners receive two kinds of income. They receive transaction income and they receive block generation income. The two differ. And under IFRS 15, revenues from contracts with customers, whereas in the case of transaction fees, there's an implicit contract between the executing party and the validating party. In the case of the block rewards, there is no contract that exists between the participating community as a whole. Therefore, the accounting treatment of the two is quite different. Transaction fees will be recognized as normal revenue for the company, whereas block creation fees will be recognized as other income. Finally, the currency translation. IAS 21, effects of changes in financial exchange, foreign exchange rates, requires that the cryptocurrency is translated into the company's functional currency, and that is done, the initial recognition is done by using the spot rate at the time which existed between the functional currency and the cryptocurrency. That's all from me. Thank you very much. Any questions? Anyone understood anything? Lots of IASs. Thank you, guys. Sorry, is there a question? Sorry, there's a question there.
Hello, thank you for your presentation. Something on mining. Germany, a few months ago, has classified the rewards from mining as non-taxable because they classified mining action as a voluntary action because the miner gives their computational power and energy. Therefore, the rewards of mining are not taxable because after a voluntary action. So then what's going on with that? Thank you.
The taxing aspect of cryptocurrencies is a totally new chapter, and we need another 20 plus 20 minutes in order to go through that. However, yes, I know that Germany did that. I think that's probably an incentive, like many other tax incentives that governments do, individual governments do give to individuals or companies in order to set up in the locally. And that is just an exception to whatever other treatments are to do with the cryptos, with the generation of revenues. Thank you.